Welcome to Capital Gains, Yahoo Finance's unique look at how US government policy will affect your bottom line now that the polls have closed. I'm your host, Rochelle Akufo. Well, now we know America has decided to re-elect former President Trump as the next president of the United States, the 47th president. Will it be a clean sweep, though? We see Republicans have taken the Senate, still some races in the balance in the House. We'll be breaking all of that down. But what does this mean for the economy going forward and your bottom line? Where does the country go from here if, in fact, President Trump does enact a lot of the policies that he mentioned on the campaign trail? We'll get into that. And of course, later on, we'll be joined by Oxford Economics Chief US Economist Ryan Sweet to discuss more on all of this. But first, of course, I have to introduce my co-stars Ben Werschel and Rick Newman. I know it's been a long slog of watching all this election coverage. So Ben, I want to first kick it off with what you have on your note card so far, if you have enough room for all of it.
Yeah, no, I pulled it together. So I have a note card of numbers for you, kind of sifting through exit polls and the results on the economy specifically to kind of kick us off today. A couple takeaways for you there. First takeaway, something we've been talking about for basically 2 years since inflation peaked, was that the intense economic costs that people are feeling. One exit poll asked people the amount of hardship they felt because of inflation, and almost 75% said it was severe or moderate hardship. So 73% said that. So that sort of tells you that kind of mood music. Similar numbers in terms of whether people are dissatisfied or angry with the way things are going in the United States. So that's the sort of setting that we kind of came into this election route, and it clearly rebounded for Trump's benefit. One number, though, that was interesting, Rick and I, we were watching it together and we were noticing this, is that one of the early exit polls that came out was that the question of who you trust more on the economy, it was actually close. It was 51% for Trump, 47% for Harris, which was very surprising after when Biden dropped out, the gap there between Republicans and Democrats was about 20 points. So that she clearly made up a lot of ground there, but it was also, as we've noted, it was sort of a head fake there. So I looked into that for a story, and real quickly, a couple numbers there, which is that one takeaway is that the actual importance of the economy in voters' minds in terms of how they responded has decreased. So in 2012, 60% of voters in an exit poll said the economy was their top issue. This year, it was 32%, so barely over half that. And actually, this year was the first year that another issue, this issue was democracy, was higher than the economy. So technically, in these exit polls, the economy was not the top issue for voters. But if you drill down further, it was the most important issue for Trump voters. Of those 32%, they broke definitively for Trump, 80-20 for Trump. So if you cared about the economy, which still a huge number of people did, you broke for Trump. Harris folks were focused elsewhere. So the bottom line is that I would still argue that the economy is still one of the top issues, if not the top issue for voters, and it broke for Trump in interesting ways that sort of led to this real red shift we saw this year. Rick, what do you think happened?
So, I mean, I think the main thing we're all thinking about going forward is what is the message that voters sent? And I still don't know what message voters sent. I mean, we've known all along that a portion of the electorate is really upset about inflation, and they are focused on the cumulative increase in prices. You know, the price of eggs has gone up by 25% or whatever the number is, and it has stayed there, and that really upset me. We've sort of known that all along, but in terms of what put Trump over the top, it's like a million small things. For some people it was this, and for some people it was that, and when you get to that, I mean, that's a weird exit poll outcome. When what's the number, Ben? 51% said democracy was their top concern. What does that even mean? I think that means totally different things to people who voted for Trump and people who voted for Harris. And perhaps we can infer that people who voted for Trump, when they say democracy, they're thinking about the socialism label that Trump tried to put on Kamala Harris, suggesting that maybe it worked. And I'm writing about this as well. I do not think Kamala Harris escaped the Bernie Sanders programs that she endorsed only 5 years ago. And I think there were some voters who thought, well, if I vote for Kamala Harris, it's like I'm voting for Bernie Sanders, because she did back the Green New Deal back in 2019. That would be a massive government intervention in the energy and transportation sectors with all these social justice things tacked onto it. She also backed Medicare for All, which would have invalidated employer-based health insurance, which is how 50% of Americans get their coverage, and many of them like that coverage. And I think people just viewed her as a radical in sheep's clothing. I can't prove it because, frankly, the exit polls don't give us that kind of granularity. But at any rate, voters heard Trump talk about tariffs, and they're fine with that, I guess. They're fine with more tax cuts or an extension of the existing tax cuts, which is going to explode the deficit, the national debt even more than it is. They think Trump is somehow going to magically get gasoline prices back to I don't know what they want, $2.50, $2 a gallon. Energy company profits are going to go down if that happens, but I guess the energy companies are fine with that too. So, and I can't wait until Elon Musk tries to cut the federal bureaucracy by, I mean, he cut Twitter staff by something like 80% after he bought it. So I can't wait for Elon Musk to get started on this and for voters to say, yeah, nobody answers the phone at Social Security anymore, but it's all good with me.
And so you raise a good point, because even when you talk about sort of that messaging on democracy and what it meant for people, sort of operating in that gray area made it easier for people to sort of take whatever they wanted from that message. And it's interesting because we saw Bernie Sanders, criticizing Democrats, saying they didn't do enough to address wealth inequality and having workers feeling left behind, and that was the tipping point. But then to hear you also say it was sort of too much of what they perceived as Kamala Harris's support of some of these more progressive policies that ended up putting the nail in the coffin. So that's an interesting one. I'm sure there'll be a lot of finger pointing still to go. I do want to get to another big winner on the night, which was Polymarket, at least the winner, Freddie 9999. At least for now, he's the winner. At first, they were saying with his bet, he pulled in about 48 million. Chainalysis is saying now his total profits are closer to 85 million now, betting that Trump would win the election. And this, of course, has also caught the eye of French gambling regulators who are wondering about these 11 accounts allegedly tied to this person. But it begs the question, were the betting markets right then?
Ben, go for this.
Yeah, I think the way it played out on election night is very telling here. So I was tracking this really closely. And then at 4 p.m., what people sort of need to remember is that the betting markets were not calling the election for Trump. So before we had any real data, Kalshi was at 57%, Polymarket was at 61%, which any statistician will tell you is not calling the race for Harris or for Trump. That means Harris wins 4 in 10 times. So it was still a tight race. It was a little bit of a Trump lean, which we can talk about why that might be, but it was still things. Where I would argue the betting markets really sort of showed their strength that night was as the early stuff was coming in. They were clearly on the early side when Rick, as we were watching it, we were like, what's going on in Loudoun County in Virginia? What's going on in Osceola County in Florida? There was a sort of wisdom of the crowds there that did sort of see a spike towards Trump earlier than most other indicators were. So that once sort of information was fed into that model, it was clearly valuable. The question is whether it's valuable in sort of other environments where it's just kind of wide open and we all have the same information and the same models to look at.
Yeah, I think the jury's out on betting markets, but the reason that betting markets have gotten as popular as they are is that the polls are not doing a very good job anymore. So, to my mind, the polls were off again. So pollsters, this goes back to when they got it wrong in 2016. For 8 years, they've been trying to correct for the way that they seem to undercount Trump voters. And I don't feel like I saw any poll that suggested, the polls all basically showed it as a toss-up. That was not really the outcome. Trump won all the swing states, every single one. So I feel like once again, the polls missed some of the Trump voters, and Trump outperformed kind of by the same margin that he has before, which is in the 2 to 3 percentage point range. So it seems like polls are broken, and so betting markets are now where everybody's looking for insights. So we're gonna get a lot more of this. You can now bet on anything. It seems like in betting markets, you can bet right now on whether you think the House is going to go to Democrats or Republicans. I haven't looked up the odds of that. It seems like Republicans, but if it's a long shot and the Democrats come from behind on that, you could make money on betting markets. So we're going to be watching these for a long time.
Indeed, and we're going to be talking more about that, I'm sure, as the year goes on. But of course, we are going to take a quick break right now, but we will have Ryan Sweet on the other side of this. Stay with us. Welcome back to Capital Gains. We now want to bring in Oxford Economics chief US economist Ryan Sweet to get his take on all these developments. So Ryan, let's first talk about your base case for what the economic outlook looks like from here, now that we at least know who's going to be the next president and we have control of the Senate here, but still waiting for some of the outcomes from the House race.
Yeah, so as you pointed out, I mean, it's still a little bit unclear who's going to have the balance of power in Congress, but the assumption is that it's going to be just a Republican sweep. So the economy is going to give it, a little bit of a shot in the arm from an adrenaline rush when it comes to expansionary fiscal policy. So the Trump administration is going to pursue tax cuts, not just for personal income, but also businesses. There's going to be, some extension of bonus depreciation. And that's going to be, and also, some increase in government spending. So the economy is going to get a big adrenaline rush beginning in 2026 and 2027. That's when you'll see the peak impact of the expansionary fiscal policy. But at the same time, there's going to be some offsets, some drags on the economy, tighter immigration policy, and also, of course, tariffs. The key thing to take away is that our forecast for next year, 2025, really doesn't change appreciably because there's a lot of political capital that's going to get tied up in what to do with the debt ceiling, with the extension of the Trump tax cuts. And by the time that this fiscal agenda starts to take shape and get passed, the economic impact really doesn't start to show up until 2026. Same thing with tariffs. It takes time. So even if Trump announces tariffs on day one, it's going to take a little bit of time before they start to really show up in the inflation data for the U.S.
Ryan, can you talk us through tariffs a little bit more? So we've been through one round of tariffs with Trump in 2018 and 2019, and most people feel like they didn't see any increase in prices. Trump kind of and his trade guy Robert Lighthizer, they kind of organized those tariffs in a way that they were like intermediate goods, not finished goods that show up on shelves, so that the price would be kind of like price hikes would be deeper in the supply chain. Are you thinking that people are going to see price increases related to tariffs or not so much?
Great question, and it's unclear. We'll walk through the economics of tariffs, but the only certainty with Trump is uncertainty, particularly when it comes to tariffs. So, you and I, the consumer, will feel the effect of tariffs if they're across the board. On the campaign trail, he said 60% tariffs on China, threw out different amounts of tariffs across the board on the EU, Mexico, Canada. If they're broad-based, then there's no really anywhere to hide from it. So that will get passed on, some of it to the consumer, and we'll see it in prices. So the price level for many goods will go up. First time around, the Trump administration phased some of the tariffs in. To your point, they kind of stashed them in steel, aluminum, some in intermediate goods. So it didn't get passed completely onto you and I. But if you look at the tariffs on washing machines, for example, that directly showed up very quickly in the consumer price index for washing machines. So tariffs are going to be inflationary. Just the magnitude of the inflationary impact or the cost that you and I will feel really depends on how aggressive the Trump administration is, whether or not the tariffs are broad-based, which would mitigate some of the inflationary impacts, or if they're across the board and there's really nowhere to hide and you're going to see the impact on inflation.
Ryan, curious what indicators you're watching to sort of see how aggressive Trump would be on tariffs. You've talked about a sort of full-blown Trump scenario versus a limited Trump scenario. What indicators, is it staff or what in the next few weeks that would give you an indication that he's going to go all in on tariffs or perhaps dial back a little bit?
Yeah, so after the election, we adopted our limited Trump scenarios, which is essentially, Trump gets what he's proposing on the campaign trail, just dialed back, not as aggressive. We have a full-blown Trump scenario, which is essentially what he's been saying, what his advisors are proposing, is that gets implemented into policy. And yeah, the difficult task is to kind of try to map what is just political rhetoric on the campaign trail to what eventually transpires into policy. So a few things that we'll be looking for is the ultimate margin in the House, the Democrats versus the Republicans, how many seats. We'll also be keeping an eye on who his political appointees are, for example, a trade representative, Treasury Secretary. And those are going to kind of provide some guideposts of where we ultimately end up when it comes to trade policy. I mean, the one thing to keep in mind is that the Trump administration knows and Republicans learned from this election that the consumer hates inflation, and they don't forget. Therefore, if you do very aggressive tariffs and it's going to temporarily increase the price level, the consumer, the voter, is going to remember when the midterms come up and when the next presidential election occurs, because inflation is politically unpopular.
So Ryan, when you look at some of the commentary from Trump supporters, they're basically saying, look, it's good that we have these high tariffs coming potentially because then people will buy American, the manufacturing will ramp up in the US. Talk about the difference between that scenario and if and when that would show up versus the actual economic impact. As you mentioned, there are some of these tariffs given the timelines that you mentioned.
Yeah, the whole idea that there's a myth that imposing tariffs is going to eliminate the trade deficit in the U.S. And that's just not going to happen. That's mathematically impossible. And the reason behind that is the American consumer. We buy a lot more stuff, goods that we import than what we produce domestically. And the idea that you're going to see this big reshoring, which we didn't see in the first Trump trade war, for manufacturing, I think is still a little bit misplaced. I mean, you are seeing some reshoring when it comes to chips, personal protective equipment, pharmaceuticals, biomeds. These are, things that the U.S. has a comparative advantage in now in producing. So, when it comes to manufacturing, the U.S. should focus on capital-intensive manufacturing. Labor-intensive manufacturing is not going to get reshored to the U.S. What the second trade war, if you want to describe it as a trade war, would do is continue to diversify supply chains. So the first trade war under President Trump, that kind of got this ball rolling. The pandemic really accelerated it, and now additional tariffs under a second Trump administration is going to cause businesses to diversify their supply chains. They're going to take more and more of their eggs out of China. It's going to go to Taiwan, Vietnam, Mexico, other parts of Central and South America. You're going to bring more supply chains closer to home. And that, I think, is going to be more noticeable than all these manufacturing jobs coming back to the U.S.
So Ryan, I want to ask you about what markets seem to be telling us about what investors anticipate. And I feel like I'm seeing two different stories. So tell me if you agree or you see it otherwise. The stock market is giddy. The stock market seems to be thinking, oh, we're going to get, first of all, we're not going to get a corporate tax increase because Harris is out. Maybe we're going to get tax cuts. We're going to get deregulation. Perhaps we're going to get more M&A activity. And the stock market is, loving all of this. The bond market, which relates to interest rates, seems to have a kind of a different story. I mean, we saw long-term interest rates creeping up even as the Fed started cutting short-term rates. So for about the last 4 to 6 weeks, long-term rates have creeping up seemingly in anticipation of a little bit higher inflation under Trump, which means that interest rates would otherwise be higher. Are those stories compatible, or what message should we be taking from market action?
Well, they've been compatible for a little bit of time, and they were compatible under the first Trump administration. After he won in 2026, you saw the stock market really rally. I think we're just following the 2020 or the 2016 playbook over again. As you pointed out, the stock market is there's improvement in sentiment and vibes that you're going to get less regulation. That's going to lead to more M&A activity, which I think is a reasonable assumption. When it comes to long-term interest rates, and this is where I think the economic costs could mount very, very quickly if long-term rates continue to move higher, is that mortgage rates are rising, and the housing market is very interest rate sensitive. We'll take it on the chin if mortgage rates get stuck at 7% rather than dropping down to 6, 5.5%. So that's something I'm paying very, very close attention to. And when you decompose long-term interest rates into its three components, inflation expectations have moved higher, but not that much, not as much as you would assume if Trump was really going to follow through with his 60% tariffs on China and tariffs on other major U.S. trading partners. But one reason why rates have really moved up, since the Fed started cutting in September, is that the economic data has been very strong. If you look at retail sales, industrial production, if you look at overall job growth, the unemployment rate has come back down. And then we did get revisions to GDP and gross domestic income, and all that suggests that the U.S. economy is doing very well. And that kind of altered markets' expectations of how aggressively the Fed's going to be in this rate cutting and rate normalization cycle. So that's also pushed long-term rates higher as well. Whether or not that sticks, the jury's still out, and I think the bond market can say one thing and the stock market can do another. So we'll see whether or not they come into more unison over the next several weeks.
Ryan, we're almost out of time, but I wanted to get a real quick, 30-second sense from you on the risks on monetary policy side of a kind of clash between Jerome Powell and Donald Trump. We saw some pretty striking comments from Jerome Powell yesterday that he wouldn't leave even if Trump tried. What's your assessment of that situation, and how big of a headwind that could be if it gets worse?
I'm not losing sleep over the idea of the Fed losing its independence. I think that would be a significant error from a policy perspective. I mean, there's plenty of academic research. There's books and books and literature around how economies perform when they have an independent central bank versus a less independent central bank. And those that have independent central banks, their economies do better. You're closer to full employment, inflation is closer to target. Powell's term doesn't end until 2026. The law is on the side of Powell. He's not going to be forced to resign. He's going to remain Fed chair until 2026. And I do think something that to keep in mind is that by the time Trump nominates and the Senate confirms a new Fed chair, that new Fed chair is going to have more of a say on the next president's economic outcome than Trump's. So that is something that there's going to be a lot of hand-wringing whether or not Trump's going to get involved with the central bank, which I think would be the extremely bad idea. But Powell's going to still continue to steer the ship until 2026, and he can stay on as Fed governor until 2028. So this could be a very interesting drama to see play out over the next couple of years.
Indeed. We are out of time, unfortunately, but we appreciate you joining us. Thank you so much, Ryan Sweet.
Thanks, Ryan.
Thank you. Great seeing everyone. Take care.
All right, before we sign off, we want to get up to speed on Rick's Trump trade. So, Rick, what's the latest?
I assume everybody in the world is following my Trump trade, but for those who might not be, I made a bet on Trump's company, ticker symbol DJT. Basically, my bet was that Trump was going to lose the election and that the value of DJT was going to go down. So I bought a put option that would put me in the money if the share price hit $25 or lower. So Trump won, and my Trump trade should be a complete bust. In theory, the value of that company, that stock price should be skyrocketing. But guess what? It is not. It is actually going down since Trump won. This is surprising some people who have been following this. So last check, the stock price is around $27 or $26. So I'm only $1 away from being in the money on my trade. So we'll see what happens. My contract expires November 15th, so I've got a week left. So if it falls below $25, I'll get back some of my money. And if it falls below $21, I'll actually start to make money. So all the drama that everybody wants to know what's going to happen next week.
I'm watching closely, at least maybe not the whole world, but I'm definitely really interested to see how this turns out, Rick. Yeah.
I am too. It'll be a champagne for everybody. Well, that does it for this episode of Capital Gains. A big thank you to Ryan, Rick, and Ben. And of course, don't forget to like and subscribe to the podcast wherever they're available. Until then, we'll see you next time on Yahoo Finance.
Welcome to Living Not So Fabulously.
We all have something money related that we want to hide.
Our podcast brings you these stories.
Living Not So Fabulously from Yahoo Finance drops on your favorite platform every Wednesday at 12 p.m. Eastern Time.